The Momo reversal is comprised of three main characteristics or components. Magnitude, which is the physical length of waves, be it impulse waves or corrective waves. Pace, which is a given amount of price increase over time. So price increase or decrease over time. And volume, which we've discussed in a prior segment. So how exactly do these combine to create this specific pattern? Well, you can see here we have a 5-wave pattern comprised of 3 impulse waves, which are labeled 1, 2, and 3, and then 2 corrective waves, which are the 2nd and 4th wave of the pattern. Impulse wave 1 should be steeper, should be more bullish in pace than impulse wave 2. That is, impulse wave 1 has more of a price increase, in this example, over a given period of time than 2 does, over the same said period of time. The same relationship is true for impulse wave 2 compared to impulse wave 3. So that is pace. Magnitude is the same, that is, impulse wave 1 is bigger than 2, and 2 is bigger than 3. There is a rule governing how big they should be, and that is impulse wave 2 should not be any less than 50% of impulse wave 1, but it shouldn't equal or surpass the magnitude of impulse wave 1. So it's between 50 and 100% in length. And the same relationship holds true for the comparison of impulse wave 3 compared to impulse wave 2. That is, 3 should be bigger, greater than 50%, but less than 100% of impulse wave 2. So that's magnitude. And then finally we have volume, and we'll show this with some examples of live or actual trading price charts, but in a nutshell, volume should fall off over the pattern. So much the same relationship as pace and magnitude, declining volume in each successive wave. The distance between A, B, and C, as depicted on this chart, that is the ends of each impulse wave, is governed by the same law of magnitude. That is, the distance between B and C should be 50% or greater, but less than 100% of the distance between A and B. Here are some examples. We have 3 examples here. 2 are incorrect, and only 1 of the 3 examples you see in front of you is correct. Which one is correct? It is example number 2. More importantly, why is number 1 and why is number 3 incorrect? Well, number 1 has everything but the magnitude in check. That is, wave 3 is significantly less than 50% of wave 2. And when I refer to wave 3 and 2, I'm talking about the impulse waves. In 3, we have everything in place except for the distance between the ends of the impulse waves. That is, point B, which is the end of the 2nd impulse wave, and point C, which is the end of the 3rd impulse wave, has a distance that is greater between them than the distance between point A and point B. That is the end of the 1st impulse wave and the end of the 2nd impulse wave. And so that's what negates that pattern. One more example here, using a long patterns this time. 1 is correct, 2 are incorrect. Which is which? Number 1 is correct. Has everything in order. What does number 2 have that is incorrect? Simply pace. based on the third impulse wave, this time our impulse waves are pointing down as it's a long pattern, and our corrective waves are pointing up, and the reverse is true for shorts. So the third impulse wave is steeper than the second impulse wave. The same is true on the third pattern, that is, the third impulse wave is steeper than the second impulse wave. So here is an actual example of a Momo reversal to the short side. But before I go on with analyzing this example as it pertains to the three components which we mentioned a bit earlier, magnitude, pace and volume, I just wanted to touch on a subject which we'll delve into deeply in the money management section, and that is entry and stop. You have two types of entry available to you as I see it, and that's anticipatory or reactionary, and there are pros and cons to each, and we'll discuss that in more detail later. And then with the stop, you can have a statistical stop, that is a given amount of ticks or pips or points which you've personally researched regardless of structure, or you can have a situational or structural stop, that is, you can go above a bar high or low, or below a bar low. You can go above a swing high or swing low, those sort of things. Structural, what you see on the chart. So looking at this example, the momentum reversal is here. Here is impulse wave 1 with its accompanying volume. The woods are here, the trees are the volume spikes there, which are 180 or 200% more than any of the woods. That's the way you can tell. So here's another example here, a tree sticking out of these woods. You can see the woods creeping up and then declining here, which dictates the end of the wave. So that's impulse wave 1. Then you have the corrective wave. Then you have impulse wave 2. Again, woods, trees. And then finally impulse wave 3. So how would you enter? If you were going anticipatory, you would look at the length of impulse wave 2 as compared to impulse wave 3. You know it can't go over 100% of the wave of the length, the magnitude of impulse wave 2. So you use that knowledge, and you know it can't be less than 50% of wave 2. So once you're within those boundaries, you look for a reversal sign. One way is volume. You can see the volume increased on this bar. It's 163 there. Let's bring this over. 163 volume. This green bar is 168, so it's increasing. And then here we get only 39, despite the high, or the break of this little ledge or numerous bar, 4 bar highs there. You get the break, higher high, lower volume. You could enter straight away there, in which case you would enter at 67.75, and then the trade would be on. It goes 2 ticks against you and proceeds to drop to 2.5 points or 10 ticks in your favor in the next 15-30 seconds. That's anticipatory. Reactionary would be a trigger of a reversal bar. So for example, 67.25 under this little reversal bar here, in which case price would go 1 point against you. That's 4 ticks, and then you'd get your 10 ticks or 2.5 points. And a third possible way, or a second reactionary entry, would be a channel break. And this is the lowest risk to reward of the bunch. That is, you get relatively less reward for your risk, because you would have got in way down here at 66.75 on the break of the channel, and it goes 1.5 points against you before then going 65.25. So you get 6 ticks for it. Went 6 ticks against you and then went 6 ticks in your favor. 2 for 10, 4 for 8, 6 for 6. Those are the different risk to reward scenarios there. Those are a few of the ways you could have entered that trade. So to summarize, volume, we have the woods, we have the trees. Let's see if it fits our criteria. Where is A? Well, this is a very broad top, so I'd take the middle. A is about there, B is there, and then if we draw along to C, you'll see that it's greater than 50% but less than 100% of the distance between A and B compared to the distance between B and C. So the peaks meet our requirements. Wave 1 is bigger than wave 2 in terms of magnitude, and 2 is greater than wave 3. Wave 3 is between 50% and 100% of wave 2. I know that wave 2 isn't between 50% and 100% of wave 1. It's significantly less than 50%, but that's an exception, a different type of momentum reversal, which we'll get into in a later video. Pace is complying and volume is complying. Okay, so here's a final example before we wrap this video up. This time it's not a short, it's a long. So let's look at this in terms of impulse waves and corrective waves. You can see I've drawn on the impulse waves here. Impulse wave 1 down is the largest and most bearish in pace of the 3 impulse waves. The second impulse wave, which is between 50% and 100% of the magnitude of impulse wave 1, is less bearish in pace. It also has less volume. And then finally you have the third impulse wave down, which is the shallowest in bearish pace, as you can see by the inclination compared to wave 2, and it's also got the lowest volume as well. So this is a picture perfect momentum reversal, and the magnitude is greater than 50% but less than 100% of the magnitude of impulse wave 2. The corrective waves just so happen to look favorable for upside, but that's not a prerequisite of the pattern. The distance between peaks B and C is greater than 50% but less than 100% of the distance between peaks A and B. So how would we enter? We would enter, let's get in close here. You have, for a reactionary structural entry, you could have any number of, dependent on how you drew that in, perhaps an entry here at 98.25, in which case you would have needed a stop greater than 1.75 points to survive that and gain from the trade. Or if you didn't take the wick and you were waiting for a close above the line, then you would get something lower, perhaps 97.75, in which case a 1.5 point stop would have sufficed by 1 tick. If you got in 97.75, you would have seen 99.75. So 1.5 points risk for 2 points gain. you've got the whole number there, which would be an obvious target, one tick below the whole number. But again, that's beyond the scope of this this video. Now, if you were doing a more anticipatory entry, you would look at volume as and magnitude as your guide to when to jump in front of the trade, so to speak. So you've got the woods here, and then you've got this big tree, which is much more than 200% of the average height of the woods. So that shows you that yes, we've got exhaustion here. We see a correction. Now we go for impulse wave 2. You see the exhaustion volume here, which is lower in volume than the exhaustion for impulse wave 1. We go for another correction, and then we come down here. We see an exhaustion here, and the volume here is 448 contracts right there at 1650. Now, something you will notice if you look at the volume, and we've covered this off in volume before, is the exhaustion volume doesn't usually occur right at the low. We usually have a retest of the low. So in this case, we have a low of 175. That looks like, no, 2. And here we have a low of 175. It took out the prior low, but it did so much less volume. So that's a divergence. Same thing here. Volume comes in way up here somewhere, as you can see with me floating over the volume, and then we have a retest on lower volume before we have the corrective wave. So what would you be waiting for here? Your volume spike here, 448 contracts, a low of 97. So we need to see 96.75 without as much volume. We see that here, a smaller exhaustion compared to the other woods, and you jump in here. Maybe you get in 97, 97 and a quarter. You take 3 ticks of heat and you get up to 99 and 3/4. 2.5 points for 3/4 point of a point risk. So that's a little, although overall the pattern failed, looking at the bigger picture, you don't need it to quote unquote succeed for you to be able to make money from it. So that's the end of this video, and we'll move on to one of the other 3 patterns in the next video.